here the Dow Jones Industrial Average. As you can see, it was up very sharply, made a nice rally, unexpected rally, I might say, since March of 2009. We had the worst day of the year so far this year, 2010, on Friday, but the market has bounced back. And when you look at this little price up in here, we closed at 10,365 December 31st, and now we're already at more than 10,560. So we already have gained 200 points in the Dow in just a couple of weeks of January. One big picture. Same type of thing that you can see on the S&P. You can see we have had a nice rally there. We have a situation here where the E-mini rallied 23% in 2009. December 31st, it closed at 1111. And when you look at the market right now, you can see again that we have had a little more rally in 2010. And the market not only has had a rally, but it has also exceeded the 50% retracement area of this move that we had all the way from this high down to this low. So we're already back up to the 50 would have to go to, by default to the NASDAQ. The NASDAQ is even closer to its old highs, as you can see. We aren't that far away from where we, previously were. It has rallied back, and on December 31st, it closed at 1859. January 15th, when I made these charts just last Friday, 1862. So that means it has barely gone up, and it may be the most vulnerable to breaking down from this point down to the lower points, as everybody has been talking about, warning about, where all these dire warnings about stocks, and they can't possibly go up. And when we look at stocks, there's a lot of ways to trade them, lots of variables at play in determining when and how and what type of stock market instrument to buy. For most of us, I guess some of our older timers, for many years that meant just the individual stocks and mutual funds. Mutual funds were created in the mid-1970s. I remember getting into one just in time at that point for a big setback in stocks, and I began to think, this is not something that I want to get involved with, and I didn't for a while, as it usually works out. Then you have the stock options that came along in the mid-1970s, the Chicago Board Options Exchange, other developments. Then along came the stock index futures in 1982, options on those futures in 1983, opened up a lot of more new trading venues that we could do. And then, of course, more recently, we have had the American Stock Exchange launching the exchange-traded funds, or the ETFs, in 1993. Now there are hundreds available, and it's become a very popular instrument. It's another attractive choice, but of course, as with any other instrument, no guarantee of success by trading a combination of stocks rather than just trading one stock. As I mentioned earlier, one stock can pull down a portfolio. Putting them all together doesn't guarantee total success. For example, about a year or so ago, I thought that natural gas would be a great way to benefit because of what was happening in the energy sector. It's a cleaner fuel. It's produced domestically. The infrastructure was in place for distribution. The economy would recover. We certainly hope so anyway. So I bought some shares in the U.S. Natural Gas Fund that was known better by the symbol UNG. That was before Exxon announced that it was buying XTE, the natural gas company, and before T. Boone Pickens came along recently and changed his mind about wind power and switched to natural gas. But as you know, there have been huge natural gas stocks. We didn't have any hurricane threats this year. That drove down the price of UNG. So the individual companies in that sector might have done well, but I was a bit too early, and so my holdings in that particular fund went down, and I still, maybe being stubborn or whatever, as sometimes investors tend to be, do have those shares. I haven't really followed my own advice sometimes to take your losses and get out. I still have those shares, and as much as I talk about trading, this is kind of my buy and hold venture for the future. Maybe I can pass that particular holding on to my kids and grandkids. Two ways to look at stocks, of course, and everybody, again, this is nothing new to you. There's fundamentals, where you have a lot of different types of things about a particular company, the shares and how they move. Right off the top, I'm going to tell you, first and foremost, that I do not pick stocks. I'm not a talking head on NBC. I don't know all the accounting details of all these companies, and so somebody with more smarts or more money knows these things. They are the people who live and eat and sleep with this stuff every day, and I don't know that about all the stocks that are out there. There are thousands of them. I do get messages on the internet like I'm sure you do, and I learn about this next great drug breakthrough or some mining discovery. I do those. I get some things. Sometimes they perk my interest, but I tend to look at the recommendation or whatever it is they give, and then say I got to check this out, and then I check out that one and maybe some other ones in that particular sector. I know sometimes they are going to come up with some great prospects, and I get excited about some of those as they come along, but I have no way of verifying the numbers. I don't know if they're correct, and I guess based on some recent experience, I get a little skeptical about what I see from company accountants and officials. So, it's not even the analysts with all the best reputations that can pick the right stock at the right time and make lots of money. So, if you are attending this webinar and expecting to get tips on which stock to buy or what the real value of a particular stock might be, you might be a little disappointed. It's not going to be a buy, sell, hold type of a webinar. I'm just going to take my big sign that I have here, my fundamentals, and I'm put a symbol that you might recognize on here, and that is I am going to cancel it out. I'm not going to look at it. They're banned. Don't go there because that's not the way that I can look at the market. What I do is I look at technical analysis because of the technical analyst's belief that everything that is known about a stock is going to be wrapped up in one thing, and that one thing is going to be the price. And of course, the price over time, and then combine that with the quantity, the volume, and you're going to be able to have a kind of a indication of what the market might do without having to know all the accounting details. For analyzing the stocks from a technical basis, I'm going to turn to the indicators from Vantage Point Intermarket Analysis software. I want to make it very clear, though, right off the front, that I am not a salesman. I'm not selling the product. I don't receive any money for any product sold, but I am more interested in trading and developing trading strategies. And in doing that, I do like to feature some of the products that I personally have used and have benefited from, and that happens to be Vantage Point as one of those tools. A couple of things about Vantage Point, and that is that the data that you see on Vantage Point is based on intermarket analysis. It involves a neural network process that determines the markets, the 25 markets that have the most influence on a target market, and then it reflects that influence in a set of intermarket data. Secondly, the price data that Vantage Point's predictive indicators does use, that I'll be showing you in a little bit here on the charts, comes from what are known as typical prices, which is the average of the high, the low, and the close. You see, most indicators on some of the analytical software, they use only the close, but this particular way of looking at markets from a typical price standpoint tends to be the most reliable. And you analyze the influence of the other markets and the neural networks, forecast price direction a day or several days ahead, depending on the length of the averages being used. Now, one of the things that I mentioned or emphasized is that Vantage Point is a short-term indicator. It makes short-term forecasts, which can be a few days. It can be up to a couple of weeks. But when we look at the Vantage Point indicators, in this case, this particular webinar, we're going to take a look at some of the things that might apply to a longer time period so that you don't have to necessarily be real active jumping in and out of the market every day. First chart that I want to look at and show you a little bit about, just to give you some background. This is a one-year chart, Abbott Labs, just to show you that the price at which it is now in the 55, 56 area, we've been there before. A year ago, we were there before we had the real slide that came down into March, as everybody is well aware. We're going to switch a couple of time frames here because it's kind of hard to show a lot of indicators when you have it that much. We now have a 6-month chart here. The typical indicator that I usually bring up when I start my analysis with Vantage Point is I look at the medium-term crossover. Again, I'm looking at this one from a little bit more active perspective. As you can see, the predicted medium-term moving average is the blue line, and it's a little bit more active than the actual medium-term moving average, which is the black line. You can also